Hi everyone, and welcome to ACCAP4 Advanced Financial Management. My name is Fred Akon, and I'm going to take you through ACCAP4, the live sessions. So let's go through what we are expected of doing today. Okay, so if you look on the screen, I have got my email address, which is facon@lsbf.org.uk. So obviously, if you have got any question and you want me to help you to address that, then straightforward, you can send it through the email and I'll be more than happy to answer you. So as I said, I am going to take you through ACCAP4. So let's see what we are expected of doing today. So today, we're going to look at issues in corporate governance, which is going to be a self-study. And we're also going to look at Advanced Investment Appraisal Session 1, which is going to be from chapter number 2. So we are going straight to chapter number 2. That chapter is extremely big, and don't use that chapter to judge all the other chapters. I normally say the biggest chapter in that your lecture note is this chapter number 2. So let's go straight to chapter number 2 of your lecture note, and then we start with Advanced Investment Appraisal 1. So let's go straight. So if you go to chapter number 2, it's Advanced Investment Appraisal Session 1. Obviously, you can't go to P4 exams without investment appraisals. Definitely, there's one question there that you need to apply investment appraisals. Okay, so now let's go straight to the note. So you will pick it from, is it to page 25 of your lecture note? Okay, the first topic we would need to learn here is going to be discounting cash flow techniques and the use of free cash flows. So we are saying the topic is investment appraisals. What do we mean by investment appraisals? If I have to pick it from F9, F9 told us that the financial manager is supposed to make 3 basic decisions. And the first decision is the investment decision. An investment decision is for the financial manager to identify which profitable investment the company should be undertaking. If you identify that profitable investment, your second stage will be to go and raise money to finance that project. If you finance the project and the profit is coming, your third decision would have been, how are you supposed to use the profit? Are you supposed to use all the profit to pay dividend? Or are you supposed to retain part of the profit and then pay part as dividend? And that is what is called dividend decision. So the investment appraisals is associated with the investment decision. And we said that investment decision is to identify which profitable investment the company is supposed to undertake. So the process of identifying that profitable investment the company should undertake in order to achieve its objective of maximizing the shareholders' wealth, that process is what is called investment appraisals. What techniques are we supposed to use to appraise the investment? There are so many techniques. Those techniques can broadly be divided into discounted techniques and the non-discounted techniques. The non-discounting techniques include the payback period and accounting rate of return. We saw that in F9. When you come to P4, we don't do the non-discounting techniques. We are only interested in the discounting techniques. And according to the discounting techniques, they are those techniques that will take into consideration the time value of money. We have to take into consideration the time value of money. So any investment appraisal technique that takes into consideration the time value of money is called a discounting techniques. An example of those discounting techniques include the net present value, internal rate of return, modified internal rate of return, discounted payback, duration, profitability index, and adjusted present values. Most of these techniques, we've met them before. Even if you haven't, I am going to explain everything from scratch. The P4 syllabus is the F9 syllabus plus other things. So even if you haven't done it, don't bother yourself too much. But the only thing is that you need to be working more than somebody who have done it before. So before we go to the exam room, you need to know how to calculate NPV, internal rate of return, modified internal rate of return, all these techniques. I don't know which one the examiner is likely to test, okay? But the most popular one will be the NPV and then the adjusted present value. If you look at the December 2014, he tested internal rate of return and modified internal rate of return. So my advice to you is that before you go to the room, you need to ask yourself, do I know how to use each of these techniques to evaluate investment to conclude as to whether the project is supposed to be undertaken or not? So that whichever the examiner will decide to do, then you are ready for it. So our lecture note is structured such that we are going to explain some basic principles of them, and we take a question to address all of them. So let's start. What is net present value? Net present value is simply the difference between the present values of the future cash flows minus the initial investment. So as we might have learned before, our NPV should be calculated as the present value of the future cash flows minus the initial investment. This is what we learned in F9. At P4 level, I am going to change the definition slightly. Why? Because of this issue of the initial investment. When we talk about initial investment, it's like the cash outflow, what we are incurring in year zero. But when you bring it to the practical level, if you bring it to the practical level, if I have to do a project, for instance, I have to construct this building and then rent it out to make money out of it. The construction of the building is not going to be finished immediately, which is now. It might take about 2 or 3 years for me to finish the construction before I will start getting the rent. So we are changing it slightly. We are going to say the NPV will be the difference between the present value of your return phase minus the present value of your investment phase. Investment phase is that if I have to use 3 years to construct this, I have to incur money now. I have to incur year 1. I have to incur year 2. Then when I incur year 0, 1, 2, 3, that period I was constructing the building. So that period is what is called the investment period. And after year 3, that is when I will start getting the rent. The monies I will be getting, which is the rent after year 3, is what is called the return phase. So at a higher level, we will say our NPV should be calculated as the present value of your return phase cash flows minus the present value of the investment phase cash flows. Okay, if you go there and you are lucky enough and the examiner tell you that, oh, there's only initial investment that is happening in year 0, it means your investment phase is just the year 0. But if I have to spend money in year 0, spend money in year 1, spend money in year 2, spend money in year 3, my investment phase is the first 3 years, isn't it? And then you also think about your return phase. That is when you start making money out of that particular project. So that is the only thing I will need to add up here. And obviously, when you have to calculate the NPV, you are saying you need cash flows, being it return phase or investment phase. So when they tell you to calculate NPV, However big, the question is, you have to be looking for only 3 things. You need only 3 items to calculate what? NPV. So any question that is asking you to calculate NPV, however big it is, don't panic. Ask the question, what are those 3 things? To calculate NPV, that's what I've done here for you. You need your number of years the project should run. Because we said it's the PV of the return phase cash flows minus PV of the investment phase. How many years overall is this project supposed to actually run? The project number of years. Then you also need the relevant cash flows. When I get the cash flows relevant, I would have to discount the cash flows. To discount the cash flows, I need a cost of capital or a discount factor. The cost of capital from this point onwards, we are not going to say, oh, just a cost of capital. I am interested in this word appropriate. So that the appropriate there means that whatever cash flows I will get as relevant, the cost of capital should be appropriate to that particular cash flows. For example, if my cash flows are after tax, it means my discount factor should also be after tax. You would have to compare like against like. That is the meaning of the word appropriate here. If my cash flows are after inflation, the discount factor should also be after inflation. So you don't just pick any discount factor and you use it to discount the cash flows. You would have to compare like against like. And this is very, very much tested in P4. It's not any WACC that you saw there, it's what you are using. You have to use the WACC that is consistent with the cash flows in order for you to compare like against like. What is the decision rule and NPV? As long as NPV is the difference between the return phase PV and the investment phase PV, the answer will be either the NPV is what? A positive figure. Either the NPV is positive or the NPV is negative or NPV is 0. If the NPV is positive, we will say the project is a profitable one, so you would have to what? Accept. The meaning is that the return from the project is greater than the cost of you financing the project, which is the cost of capital. The same way, if the NPV is negative, obviously you have made a loss. NPV measures the total profitability or loss of the whole project. Then you will say you would have to reject it. The meaning is that the return from the project is less than the cost of the capital. The same way, if the NPV is 0, you haven't made a profit, you haven't made a loss. This is where we will say the project has what? Break even. When the project break even, will you accept it? Will you reject it? Whether you do it or not, I'm not increasing anything. Therefore, here, I'm going to be indifferent. I'm going to be indifferent. Whatever I will do on financial grounds, it doesn't mean anything to me. And this is the point we will say your return is exactly equals to your cost of capital. So this is the basic thing. Anytime they want you to calculate NPV, just go straight and tell the question, where is your number of years? Where is your relevant cash flows? Where is the appropriate word? Cost of capital. So this is a refreshment of whatever we have learned before. Now let's go to the next. Economic rate of return. What is the economic rate of return? Alternative name for economic rate of return is what is called the internal rate of return. The common name we use is the internal rate of return. What is that internal rate of return? I know textbook says internal rate of return is the discount factor or the rate that will make the NPV equals to 0. Okay? If it's the rate that will make the NPV equals to 0, I normally find it very difficult to understand, because when you tell a footballer internal rate of return is the rate that makes the NPV equals 0, how can that person understand? Okay, the common sense is when I'm going to do a project, I have to raise money to finance it. The money I am going to raise to finance it, the person giving me the money is expecting to charge me a return. The return the provider of capital is charging me, I see it as what? A cost, and that is my cost of capital. what should be the maximum cost of capital I should be prepared to raise the money to come and finance that particular project. Okay, the worst case scenario of the project is that the project should give me NPV, which is equals 0, for me to at least break even, isn't it? So the maximum cost of capital I would have to get the capital to finance the project should be the cost of capital that will let the project break even. And for the project to break even, this is what we said. For the project to break even, your NPV should be equals 0. And for the NPV to be equals 0 for you to break even, it means that maximum cost of capital is that the return from the project should be equal to that cost of capital. So in layman's point of view, internal rate of return is the maximum cost of capital you should be prepared to pay in order to raise the money to finance that particular project. Okay, so let's go back here and we see that we've seen the formula for calculating internal rate of return. To calculate internal rate of return, I need two discount factors and their corresponding NPVs. So the two discount factors, one should be lower than the other. So the formula for calculating internal rate of return is basically the lower percentage plus the NPV of the lower divided by NPV of the lower minus the NPV of the higher, all multiplied by higher minus what? The lower. And that is how we calculate internal rate of return. As I said, we are just explaining this, all of them, and when we finish, we pick a question to summarize all of them together. Okay, so next, what is the decision rule and internal rate of return? The decision rule is that as long as the internal rate of return is greater than the cost of capital, you would have to accept it. Okay, let me do it here because we will need that analysis later on. So for internal rate of return, if your internal rate of return is greater than the cost of the capital, then you would have to accept it. Why? The common sense is that this is the actual cost you are paying to take over the loan. But the rate that will make the NPV equals 0 is the internal rate of return. So if I raise the money at a cost of 15% and the internal rate of return is 20%, this 20% is what will make the NPV equals 0. So any cost of capital I will raise the money at, which is less than the 20%, obviously the NPV should be equals to what? Positive. That is the reason why we're saying that if your internal rate of return is greater than cost of capital, accept the project. Why should you accept it? Because the NPV at that level is equals to what? Positive. If your internal rate of return is less than your cost of capital, obviously you have to what? Reject it, because at that point your NPV is going to be what? Negative. So in a given question, A, calculate NPV, B, calculate internal rate of return. If NPV is telling me I should accept the project, internal rate of return automatically should also tell me I would have to accept the project. Okay, because for the NPV to be positive, it means the cost of capital I use is obviously less than that particular internal rate of return. So that is the decision rule. Now let's go to discounted payback. What is discounted payback period? Discounted payback period measures the number of years the present value of the cash flows from the project will be able to recover the initial investment. If you remember from your F9, we did payback period, and payback period measures the number of years the raw cash flows. And that was criticized on the basis that that payback period does not consider the time value of money. So to consider time value of money, we have to find the present values of it. And that brought about what is called the discounted payback. So discounted payback simply measures the number of years the present values of the cash flows will be able to recover the investment that you have made, isn't it? So that is that. What is your decision rule? The decision rule and discounted payback is that you have to accept the project if the discounted payback period is less than a target discounted payback period. If your discounted payback period is less than a target discounted payback period, what is the common sense application here? So when I go to the exam room and the examiner wants me to use discounted payback to come out with a conclusion as to whether a project is supposed to be acceptable or not, then for me to be able to form that conclusion, the question in front of me should give me what? A target discounted payback. If the examiner don't give me a target discounted payback, I wouldn't be in position to judge as to whether the project should be what? Financially acceptable or not. Okay? That is why payback and discounted payback is criticized on the basis that it is very subjective. It doesn't give objective answer. For MPV, the moment I calculate and it's positive, I don't compare with anything, I accept it. But for discounted payback and even normal payback, you would have to compare it with a target. So for you to be able to conclude, the question should give you a target. If the question don't give you a target, you need to tell the examiner, it's a trick. You need to tell the examiner that unfortunately, because you haven't given me a discounted payback period target, I am not in position to come out with a conclusion. So that is the decision rule there. Now let's go to relevant cash flows. As I said, we're just summarizing everything. We take a question to sum them up. We said to calculate MPV, you need three things. You need number of years. Nobody teaches that because every question is supposed to specify that. We need relevant cash flows. What are relevant cash flows? We need appropriate what? Discount factor or cost of capital. We need to know how to calculate the cost of capital. We need to know how to calculate what? The relevant cash flows. Number of years examiner is supposed to give it to us. So at this point, we're going to learn the relevant cash flows. At another point, we're going to see how to calculate the cost of capital. So let's see. Relevant cash flows are those cash flows which will influence the decision as to whether the project is supposed to be undertaken or not. And for the cash flow to be relevant, it should relate to the future. And then it should be incurred as a direct consequence of that particular project. In other words, it should be specific to the project. That cash flow should come as a result of undertaking that particular project. It should be specific to that particular project. Any cash flow which is not specific to that particular project is not directly attributable to it. And once it's not directly attributable to it, it's irrelevant in you using to take the decision as to whether you have to go ahead or not. So for the cash flow to be specific or should relate to the future, that cash flow should be incremental. What will be the additional cash flows? Okay? What will be the additional cash flow? So for instance, if I have to do this project and I'm going to make a sale, what will be the additional sales I'm going to get? That additional sales I'm going to get is a factor I have to consider before I will decide whether I have to go ahead or not. The next level is avoidable cash flows. I don't normally use variable costs. When you go through textbooks or the lectures that you've done before, some uses variable costs. If you use variable costs, it is like fixed cost is irrelevant. Okay? When you use variable costs as being relevant, there's no argument about that. Variable costs are marginal costs. They are additional costs. In effect, they are incremental costs. So automatically, they are relevant. But when you say only variable cost is relevant, it sounds like fixed cost is irrelevant. Okay? And that is not the argument. The argument is for there to be relevant cash flow, that cash flow should be directly attributable or it should be specific to that particular project. Therefore, what is the fixed cost? When you come to the fixed cost, we've got two types of fixed costs. We've got what is called specific fixed costs and general fixed costs. Specific fixed costs are those fixed costs that will arise as a result of undertaking a particular activity. So like P4, my salary is a fixed salary. So as long as they have to decide whether we have to run P4 or not, they would have to consider my salary because my salary is specific to P4. But if my salary is not specific to P4, but I'm teaching so many other subjects, whether we do the P4 or we don't do the P4, my salary will be paid. And as a result of that, it becomes a general fixed cost. Okay, so when you see fixed cost, please make sure you consider the issue of, is it specific or is it general? General fixed cost, like the chief executive salary, whether the project will be undertaken or not, that chief executive salary will still be incurred. So it's irrelevant in taking that decision. So sometimes, instead of the examiner saying specific fixed cost, he will say direct attributable fixed cost. That fixed cost is directly attributable to that particular word, project. And then opportunity cost, of course, is the benefit that you would have to forgo as a result of undertaking the project. As a result of undertaking the project, there might be a benefit I would have to forgo. Irrelevant cash flows. Depreciation obviously is irrelevant. Why? Because depreciation in the first place does not involve movement of cash. So when I'm talking about cash flows, depreciation is out. Then we also have to think about apportioned fixed cost. Apportioned fixed cost is what is also called the general fixed cost. The general fixed cost. So general fixed cost is simply irrelevant. General fixed cost is simply irrelevant. That is why it is there. Okay, interest payment. Be with me here. Most students misinterpret this. Interest payment, okay? The argument here is, in order for me to raise money to finance the project, I've gone in for debt. And when I go in for debt, I would have to pay interest, okay? So somebody will say, if I have to go in for that interest, that loan, I would have to pay interest. So interest is relevant. Of course, interest is relevant, but which interest? This is what brings the confusion in the room. Which interest? When you are talking about interest, assuming I went in for 10% loan of 10,000, I've got interest rate of 10% and I have got absolute amount of interest. 10% of that 10,000 is what? 1,000. So somebody will say every year I would have to pay interest of 1,000, which that interest is specific to this particular project. So it should be relevant. This is what they miss. Okay? This absolute amount of the interest of the 1,000 is what we are saying is irrelevant. Why? Because this relative percentage of the interest is part of the cost of capital you are going to use. So if it is part of the cost of capital you are going to use, then if you use it as cost of capital and you also come and bring this 1,000, you have duplicated the effect of what? Interest. So this absolute amount of the interest is simply irrelevant. But the relative amount of this interest, which is the 10%, is part of your work. And therefore, that is where the relevance of the interest is. So don't bring it as cost of capital. And when you finish, you also come and bring it as an absolute figure of 1,000. You have treated it what? Twice. Okay, so interest is out. Sunk cost. Sunk cost is also the same as what? Past cost. We said for there to be a relevant cash flow, the cash flow should relate to the future. So if it should relate to the future, obviously the argument is that any cash flow which had already been incurred is not part of the argument. It becomes what? Irrelevant. So sunk or past cost is simply irrelevant. What is notional cost? Notional cost is very, very close to opportunity cost. Opportunity cost is a benefit forgone. So as a result of doing P4 in this room, we know this room can also be rented out and we will get £1,000. So if we have to do the P4 in this room, we cannot rent it at the same time. So it's like we are going to forgo the 1,000. That 1,000 is what could be either opportunity cost or notional cost. So be with me. They are very, very, very close. Opportunity cost and notional cost are very, very close. So be with me here, okay? It becomes an opportunity cost if I decide not to decide not to do the P4 in this room. There is somebody outside there who is ready to rent the place. So if there's somebody outside there who is ready to rent the place, then by doing the P4, I am forfeiting that 1,000 I would have got every month. That becomes an opportunity cost. But if there is nobody who is ready to rent the place, then the argument is, it is in my head that if I don't do the P4, I could rent it for £1,000. And that £1,000, whether I do the P4 or I don't do the P4, because nobody is prepared to rent it, I wouldn't lose that 1,000. And as a result of that, that becomes what? A notional cost. So notional cost is a benefit you thought you would have what? Forgone, but you wouldn't forgo it. So that becomes irrelevant. Opportunity cost is a benefit you will forgo. So this is the difference. Is there somebody available to take over that? So a benefit you forgo is an opportunity cost. A benefit you thought you would have forgone becomes what? A notional cost. So watch out for the difference. The reason why I'm explaining all that, if you look at the June 2014, the examiner calculated the MPV wrongly, brought in so many irrelevant cash flows and relevant cash flows, and it was the student's responsibility to correct all of them. And I can remember one of the irrelevant cash flows was the absolute amount of interest. And that absolute amount of the interest obviously is supposed to be out of the argument. So watch out for some of these things. One aspect of cash flows is also working capital. And we all know that working capital is part of the capital you have to invest. Working capital is the capital you have to use to run the business on day to day. If you want to do your business, you need your non-current asset. You have to put down the equipment and the land and the buildings. You also need the working capital to run. So the total capital you put in is your fixed capital plus your working capital. The argument we make in investment appraisal is that working capital should be recovered at the end of the period. Even if the question don't tell you, you have to come out with the assumption that working capital is supposed to be recovered at the end of that particular project life. We will take figures to illustrate. So now let's come to inflation. Let's come to inflation and project appraisals. When we are calculating the cash flows, one other aspect we would have to consider is what is called inflation, because inflation is increase in prices. So when you read the question and there is inflation in the question, you need to be very careful. Your starting point is going to be of the fact that how will inflation affect my cash flows, and how will inflation affect my discount factor? That is the question you need to ask yourself before you start calculating. Anytime you are calculating the cash flows or MPV and you see inflation in the question, just ask yourself, how will the inflation affect my cash flows, which is the revenue, and how will the inflation will also affect my cash flows, which is also including the cost. We all know inflation will increase them. So you ask, how will inflation increase my revenue, which is the selling price? How will inflation increase my variable cost and my fixed cost? Then when you finish, you ask yourself, how will inflation affect my what? Discount factor. And as we said, the discount factor that we have should be consistent with the cash flows. So if I have inflated or increased those cash flows, then the discount factor I also use should also be what? Inflated. So that the cash flows are inflated, discount factor is inflated, and I'll bring myself to the same what? Level. Okay, so let's introduce some terminologies. When do we say something is in money terms? If something is in money terms, alternative name is that it is in nominal terms. So when I say the cash flows are in nominal terms, or the cash flows are in money terms. They are just alternative words. It means those cash flows are already inflated. So when I pick a cash flow and I inflate it, the answer I will get is what is called in money terms or in what? Nominal terms. So nominal cash flows are inflated cash flows. Alternative will be what is called real cash flows. Real cash flows are those cash flows which is not yet inflated. So when I pick a real cash flow, I haven't yet inflated it. When I inflate it, I convert it from real to what? Nominal. So real cash flows are simply the cash flows which are not yet inflated. Nominal cash flows are the cash flows which are already what? Inflated. Okay, so that is the case. And what did we say? We said that to calculate the NPV, your discount factor should be consistent with your cash flows. So if my cash flows are nominal, my discount factor should also be nominal. You have to perm them. So if my cash flows are nominal or in money terms, it means they have already been inflated. What discount factor should I use? The discount factor I will use should also be nominal. You would have to compare like against like. If my cash flows are real, meaning that I haven't inflated them, then the discount factor should also be what? Real. You have to compare like against like. That is why I'm interested in the word appropriate. So the discount factor, you need appropriate discount factor. And the appropriate means you have to compare like against like. Don't pick the discount factors anyhow. So therefore, what we're going to say here is that if the cash flows are nominal, consistently, discount factor should be nominal. If it is real, discount factor should be real. However, what is of the case whereby I have got my cash flows to be nominal, but the discount factor given to me is what? Real. I cannot crisscross them. I cannot use real discount factor to discount a nominal cash flow. I have to bring them comparing like against like. So it will be my responsibility to convert the real to nominal before I can multiply. The same argument, if they're giving me real cash flows and they've given me nominal discount factor, I can't do these two, no way. So what should I do? I also have to convert from nominal to real before I will multiply. And how do we do that? This is what Fisher gave to us. And Fisher says 1 plus the money rate is equals to 1 plus the real rate multiplied by 1 plus the inflation rate. Okay? And this inflation is basically the general inflation rate. So let's go to our note. We pick this one to illustrate. Okay. So let's go straight here. We take this simple example. A company has a nominal cost of capital of 18% per annum. Required if inflation is 6% each year, calculate the company's real cost of capital to the nearest 0.01%. So giving me nominal and giving me the inflation rate, how will I be able to calculate the real? Fisher told us 1 plus the money rate or nominal rate is equals to 1 plus the real rate, 1 plus the inflation rate. So giving me any two, I should be able to calculate the third one. So 1 plus n. N is the nominal rate or the money rate. Question said nominal rate is 18%. Okay, so I will say that let me ask a question. Does all give the same answer? I mean, using nominal cash flows with nominal discount factor. Yes, all of them will give you the same answer. I'm going to illustrate soon. So I will say here that 1.18, because the nominal is 18%, is equals to 1 plus R I'm looking for, and the inflation rate is what? 6%, so 1.06. So I'm looking for this R. What should I do? All what I have to do is that, okay, let me come here. All what I have to do is going to be of the fact that 1.18 is equals to 1 plus R, 1 plus what? The inflation rate, and that inflation rate is 6%. I'm looking for R. Divide here by 1.06. 1.06, this one will go, and then I will have 1 plus R. If I divide 1.18 by 1.06, then you're going to have 1.1132. Because I need R, 1 should cross. So 1.1132 minus 1 should be equals to R. R should be equals to, can I say, 11.32%. So this is just a basic thing that you would have to think of calculating, okay? Next, let's go up to the note, and then we see that the question that came, this is what we are going to use to illustrate. So be with me here. NPV should be calculated in money terms, meaning NPV should be calculated in nominal terms. So therefore, when they ask you to calculate NPV, normally you are going to calculate it on the basis of nominal or money terms, because we want to see how much the shareholders' worth will increase in money terms, how much the shareholders' worth will increase, and that how much ought to have taken care of inflation. So NPV is normally supposed to be calculated based on nominal. However, if you go to the exam room and the inflation rate is just 1 for all the cash flow items, sales, variable costs, everything is based on 1 inflation rate. Instead of me inflating all the cash flows and discounting it using the nominal discount factor to get the NPV, mathematics can tell me that, okay, don't waste that time to inflate all the cash flows. Factorize the inflation effect out, okay? And as such, I will keep the cash flows in real and discount it using what? The real discount factor. So you can only use the real approach. Be with me here. You can only use the real approach if there is only 1 inflation rate for all the cash flow items. If I go to the exam room and the selling price is different inflation from variable cost, fixed cost, and all that, as long as there are more than 1 inflation rate, I cannot use the real. You can only use the real if there is only 1 inflation. I'm repeating that because this is what he did in the June 2014. As I told you, he calculated the NPV wrongly. And the argument was that, okay, even though selling price is subject to different inflation, variable cost is subject to different inflation. The trainee accountant who calculated the NPV said that I am not going to inflate the cash flows because I will discount the cash flows using real. And is it right? It is not right. You can only use the real if all the cash flows are having the same word. If all the cash flows are having the same inflation rate. So the moment they are having different inflation rate, automatically you would have to what? Inflate them and use the nominal approach. And that is what we are going to illustrate here. So let's take this example to illustrate. A project requires an outlay of 1.5 million in year 0 and will repay cash flows in real terms, today's prices, as follows. Year 1 up till year 3. A company's money cost of capital is 15.5%. Appraise the project if inflation is estimated to remain at 5% per annum. As long as these cash flows are subject to 1 inflation rate, I can decide to use what? Real or nominal. All of them will give me the same word, answer, full stop. But if the cash flows were subject to different inflation rate, automatically I can't use the real. I would have to think of using the nominal. So watch out. Okay, so if we are using the real analysis, we are not going to inflate the cash flows. If we don't inflate them and the cash flow stays in real, we cannot discount using the nominal or money cost of capital. We have to convert it from nominal to real, isn't it? Okay, we have to convert it from nominal to real. So this is what we've done here. So if you follow with me in the note, first approach that we are using the real, we didn't inflate the cash flows. We picked the cash flows as they are. And then I would have to convert the nominal discount factor of 15.5 to the real, because once this is real, I also need real discount factor here to compare like against like. But they gave me the nominal. How will I convert it? We've just illustrated. You have to use the Fisher equation. And Fisher equation is telling you your 1 plus the money rate is equals to 1 plus the real rate, 1 plus the inflation rate. So effectively, 1 plus the money rate divided by 1 plus the inflation rate minus 1 will give you the real, just as we did. So when I do the real, I'm going to get what? 10%. If I get the 10%, I discount the 10%, go to your table, pick what? 10% from the discount factor table, which I believe everybody knows how to read it. I normally use my calculator, so it's okay. Discount factor is calculated as 1 divided by 1 plus r raised the power what? N. And that is what we've done here. Okay, so if you go to the table, you can pick 10%, put them here, multiply by them, and then you get the PV. This is the NPV that you will get. If we have to use the nominal approach, then what are we supposed to do? The nominal approach will tell us that the cash flows are supposed to be inflated and the discount factor is also supposed to be inflated. So if the cash flows are inflated, they are nominal. If the discount factor is inflated, it's also nominal. What has the examiner given to me here? Examiner says money cost. It means money cost of capital. It means the examiner had already inflated it for me. So that is what I will pick. But these cash flows are not yet inflated because they said they are in real. They are in today's terms. Be with me. If they are in today's terms, it means that these cash flows all are represented in year 0. And they are subject to inflation of 5%. So this is what you're going to be. Be with me here. Year 0, you put the initial investment. Okay, you put the initial investment. Year 1, the real cash flow is 670. And if it is 670, what are you supposed to do? You are supposed to inflate it. How many years is from year 0 to year 1? Only 1 year. Remember, they said the 670 is in terms of year 0. So if you are going to year 1, I will multiply by 1.05 raised the power 1. This 500 is in terms of what? Year 0, but it is year 2 cash flow. Year 0 to year 2, how many years? 2 years. That is why you see 1.05 raised the power 2. The 1,200, even though it's in year 3, it is in terms of year what? 0. From year 0 to year 3, 3 years. That is why you've done 1.053. And then this will be your nominal cash flows. And if it is a nominal cash flows, you have to discount them using nominal discount factor. And the nominal discount factor was given to us as 50.5. Okay, and when you discount, you have to come and get the NPV. You see that all of them are simply what? The same. This real approach can only be used if there is only one inflation rate. Please remember. So that is basically that. Now let's go to another aspect of investment appraisal generation of the cash flows. Okay, all these, some of you who did F9, you appreciate it more, but I'm just bringing in some bit and pieces in here. Okay, it's the same old story. So taxation and project appraisals. When we saw inflation, I told you that when there is inflation in the question, there are 3 things you have to look for. The first thing is, how will inflation affect my revenue? How will inflation affect my cost? And how will inflation affect my discount factor? That's it. Same argument with tax. When there is tax, you are handling 3 things. First is, what will be my tax on my cash profit? And what is the cash profit? It's your sales minus your variable cost minus your specific fixed cost. And that is what gives you the cash profit. So when I get the cash profit, I apply my tax rate on it. And that will give me my tax word on cash profit. So this cash profit minus your tax rate will give you the cash profit. Also look at tax savings on capital allowances, which some people call it the tax allowable depreciation. And that tax savings is the capital allowance multiplied by the tax rate. And then the last one is we are dealing with cash flows, and cash flows are supposed to be prepared on the basis of receipts and payment. So when is the tax supposed to be paid? Am I supposed to pay it in the relevant years, or am I supposed to pay it in arrears? That's it. So if you have this framework and you are solving the question, you just ask, okay, where is my cash profit? The moment I get my cash profit, it means my tax should come up. I multiply the tax rate by the cash profit. I go and ask the question, when do you want me to pay the tax? Because of this timing. Do you want me to pay in year one, or do you want me to pay in arrears? Question will answer me, I do it. I come to capital allowance. Where is the capital allowance? I calculate it, I multiply by the tax rate. When is tax supposed to be paid? Is it in relevant years, or is it in arrears? You won't skip it. You will definitely not skip it. Okay, so that is done. So let's go and take this big question to summarize whatever we have done. Okay, now I'm putting you straight. I'm not waiting for the revision to bring all these, because one major problem in P4 is time. Time is of an essence in the P4 exam room. The questions are big, and as such, you have to be fast. Okay, some of you, what do? When you get a big question, you use highlight pens. You highlight everything, and you end up highlighting all the question, because everything there is important. And when you finish, you cannot even read it because you've changed the color of that particular word question in front of you. That is not good exam technique, because if I highlight here, let's say I highlight here like this, is it telling me it's an example? It doesn't tell me. Some of you use different colors. It's not helping, because all what the highlight is telling you is that, oh, there's something good there. There's something good there. What is good there? You don't know it. You still have to start reading the whole question again when you start solving it. You wouldn't have time to be reading and reading and reading. So as you are reading for the first time, you should be using your pen, not the highlight pens. Use your normal pen. Indicate every paragraph. Indicate what is in that particular paragraph, so that when you look on the sheet, you know exactly what you are supposed to pick from what paragraph. You don't have to be reading the whole question again. So my advice is, if I have to solve a question, I start with my requirement. My requirement is I have to calculate MPV, internal rate of return, and discounted payback period. How will I calculate that? Okay, to calculate MPV, I need three things. I haven't even gone to the scenario. You let the scenario be there. Don't go to the scenario first, because most often when you go to the scenario, examiner is passing sentences and then it is pushing you out of your principles. Go back to the principle first. Ask yourself, what am I supposed to calculate and how is it done? I am supposed to calculate MPV. I ask myself, how is MPV calculated? MPV is calculated using three items: number of years, relevant cash flows, and the appropriate discount factor. So when I'm going to read this scenario, I'm going to look for these three items. What are the number of years? What is the number of years? What are the relevant cash flows? And then what will be the appropriate discount factor? That is all what I need. Anything in the big scenario that is not helping me to get these three items is not relevant in calculating my NPV. Maybe it's relevant in doing another sub question so far as that big question is concerned. So that is the trick. It's all about you being tactical. Otherwise, you just go and read and come back. Time will not allow you to be doing it. Okay, so let's start. Jetaco is considering a project whether or not to commercialize an innovative muscular toning device, MTD, that will be used in the treatment of sporting injuries. It is expected that the commercial life of MTD will be 4 years. Has something come up? Because I need number of years, I need relevant cash flows, and I need my appropriate discount factor. Here they're telling me it's 4 years. Most of you will highlight it. Is it telling me that is where the number of years is? I am not going to use a highlight pen to highlight it. All what I'm going to say is, I indicate here, NY. Use your own abbreviations. My NY here means number of years. You use your own abbreviations. I move on. After which technological advances will bring more sophisticated device to the market and the sale of MTD will fall to virtually zero. 8 million has been spent in developing and testing the device over the past year. Has something come up? So whilst I'm reading the question, I'm actually indicating what I need and what I don't need. Okay, it is telling me here that 8 million has been spent in developing and testing the device over the past year. Any cost, I'm looking for relevant cost. Any cost which is already incurred, which is a past cost, is seen to be what? Irrelevant. Or because it is what? A sunk cost. So I will say this is a sunk cost. I'm using my own abbreviation. Even if I want, I will cancel this because I know it is irrelevant. I move on. Initial market research has been conducted at the cost of 2.5 and is due to be paid shortly. Okay, this 2.5, the work has already been done. The work had already been done. So whether this 2.5 is paid or it will be paid in the near future, as long as the work had been done, the cost had already been incurred and it is a past cost. So this is also sunk cost. Some people will say it's a committed cost. Okay, it's a committed cost. Because you have already committed yourself and that becomes what? Irrelevant. So this one too, I don't need it. So whilst I'm reading, I'm answering because I know what I'm supposed to be doing and what I'm supposed to be looking for. By the time you finish reading the question, you know where to pick whatever. You start solving it straightforward. Information on future returns from the investment has been forecast to be as follows. Year 1 to 4, unit demand, selling price in current price terms, variable cost in current price terms, fixed cost in current price terms. So these are the unit selling prices and all that. This is very obvious, so I'm not going to waste time to indicate anything there. The moment I look on the sheet, I know where to pick them straightforward. I move on. Selling price inflation and fixed cost inflation are expected to be 5% per year, and variable cost inflation is expected to be 4% per year. Fixed costs represent incremental fixed production overheads, which are wholly attributable to the project. That paragraph, what common sense should I pick from there? This paragraph is telling me inflation and it's telling me that the fixed costs represent incremental fixed costs, fixed overheads, which are wholly attributable to the project. So this fixed cost is specific fixed cost. We said specific fixed cost is relevant. General fixed cost is irrelevant. And I move on. The production equipment for the new device will cost 120 million. So this is my initial investment. And an additional initial investment of 20 million will be needed for working capital. This is my working capital. The equipment is expected to be sold at the end of 4 years for 10 million when the production and sales ceases. If I have to sell it at the end of the 4 years for 10 million, that is the residual value. The average general level of inflation is expected to be 3% per year, and working capital will experience inflation of this level. I will say this is my general inflation. You have to use your own abbreviations so that you understand them. Okay, capital allowances tax allowable depreciation on a 25% reducing balance basis could be claimed on the cost of equipment. Profit tax of 30% per year will be payable 1 year in arrears. A balancing allowance will be claimed in the 4th year of operation. Jetterco has a real cost of capital of 7.8%. So this is my cost of capital. This is what? Capital allowance, and then what? Tax. I have to calculate NPV. So instead of me highlighting, I haven't highlighted anything. I've got everything adjacent here or there. So if I have to start solving this question, I don't have to be reading every paragraph again. When I need number of years, for instance, if I need number of years, the moment I look on my sheet, I know that this is where my number of years is. I come and read that paragraph to pick it. If I want tax, I know this is where I indicated tax. I read that paragraph alone and I move on. You don't have to waste time reading and reading and reading. Nobody is going to allow you that time. So let's go and solve this question. Okay, let's go and solve this question. So to solve this question, to calculate NPV, I am going to say years. How many years is this project supposed to run? 4 years. So I'll say year 0, 1, 2, 3, and then 4. I leave space in case something should go to year 5 in terms of arrears. Okay, for the purpose of tax, I'm going to start with my sales items. So what is my sales? My sales should be my selling price multiplied by the unit. I'm going to do things in thousands. Okay, so I indicate that quickly. So what will be my sales? I will need to go and do workings and bring myself down. Okay, so let's go down there and we start with our workings. So my workings 1 is going to be on sales. Year 1, year 2, year 3, year 4. It involves a lot of working. So you have to be on your heels. You have to be moving. That is why there's no time for you to be reading and reading and reading. You can't be reading and reading. That is taking your time. Okay? So I'm going to say, what is the selling price? According to the question, the selling price is what? 2,000, 2,200, 1,600 and 1,500. But question said the selling price is in current price terms. If it is in current price terms, what is the meaning? It means these figures are in terms of year 0. But this selling price is subject to what? Inflation. Now be with me. If you go to the question, I have got different inflation rate. Once I have got different inflation rate, I can't think of using the real. Automatically, I would have to use the nominal approach. Okay, so I'm using the nominal approach and all the cash flows are supposed to be inflated using their respective inflation rate. Selling price inflation, this is the paragraph. I will come straight because this is where I have indicated. I don't need anything from anywhere. I come to that paragraph straight. And selling price inflation is said to be, is it 5%? So this is going to increase by 5%. And because all these cash flows or selling prices are in terms of year 0, I will say 1.05 raised to the power 1, 1.05 raised to the power 2, 0.5 raised to the power 3, 0.5 raised to the power what? Is it 4? And you multiply. What figures are you going to get? This is it 2,100? This is 2426. This is 1852, and this is 1823. This will be the inflated selling price. If this is the inflated selling price, I would have to multiply by units. What are the units? You go to the question. Year 1, unit 20, 70, 125, 20,000. Pick them quickly. So we are doing 3 zeros up. So I'm going to say 20, 17, 125, and then what? 20. When you multiply, that should give you your nominal sales. And what is the sales figure? This is the 42,000. This is 169,820. This is 231,500. And this is 36 what? 460. Have I got my sales? I've got the sales. I have to go and put them in my cash flows. Okay, so we move ourselves up. What are the sales figures? Year one, we said is 42,000. This is 169,820, 231,500, and then 364,60. That is my sales. My next level is variable cost. We go and do the same workings for the variable cost. It's a template you are following. Okay, so workings 2 is on variable cost. Year 1, year 2, year 3, year 4. Okay, and this is going to be what is the variable cost per unit. When you go to the question, they said 900, 1,000, and then 1,020 and 1,020. Remember, all these cash flows are in today's time, so they are like real. They are not yet inflated. So I have to bring the variable cost inflation. They said that variable cost inflation, according to the question, is telling us which paragraph should I go? Which paragraph did I indicate inflation? That is the paragraph. And I see variable cost inflation to be 4%. You know the spot you would have to be going. You don't waste time reading other paragraphs. Just go to the paragraphs you have what indicated. Pick the figures from there and you are just moving on. So 4%. So if it is 4%, I'm going to say 1.041, 1.042, 1.043, 1.044. And when you multiply, what are you going to get? 936, 1082, 1147, 1193, and I have to multiply by unit. Units are 20, 70, 125, and then 20. Multiply them quickly, and that is 18, 720. This is 75, 714. This is 143, 375. This is 23, 860. These are my variable costs. Having got the variable cost, I move myself up, isn't it? Having got the variable cost, I would have to move myself up. So let's go up there. We come and put the variable cost. Variable cost, remember, is simply a cost. So you need to put it in bracket. It's 18,720, 75,740, 14,3375. And then 23,860. Okay, then when I get to fixed cost, you have to pause, because the fixed cost, we've got two types of fixed cost, either specific or general. And whilst I was reading the question, I was able to indicate specific fixed cost, because the question is telling me the fixed cost is wholly attributable to this project. So it's specific to this particular project. And the fixed cost given were 10,000 or 10 million in current price terms. They are in terms of year what? 0. So I also have to bring that fixed cost because it is basically what? Relevant. So let's go back and then we go and do workings on the fixed cost. So this is specific fixed cost. I come down here quickly. Where is the fixed cost? 3. Workings fixed cost, year 1, year 2, year 3, year 4. Okay, what is the fixed cost? They said it's 10 million. We're doing 3 zeros up, so it should be 10,000. Do I even have to do this working? No, my calculator can do for me. Inflation, fixed cost inflation, they said is 5%. Raise the power 1 here, 1.052, 1.053, 1.054. You have to be on fire. You have to be moving. That is why I'm pushing you right from day one. Okay, it's not something you have to be hesitating. It's time pressured. So when you multiply, are you getting 10,500, 11,025, and 11576 and 12155? Fixed cost is done. So I move myself up to, and then I'm going to calculate or put the fixed cost down. And the fixed cost here is giving us, is it 10,500, 11,025, and then 11,576 and 12,155 minus. I have done my sales, I've done my variable cost, I've done my fixed cost. The moment you do those ones, my cash profit is ready, because we said the cash profit is the difference between your sales minus your variable cost minus your specific what? Fixed cost. So when I sum this, is giving 12780, 83055, 76549, and then this is 445. Okay, when I get my cash profit, something should come up, because we said if there is tax in the question, there should be tax based on your cash profit, there should be tax on your capital allowances. So what is my tax on my cash profit? I go to the question, ask the question, what is the tax rate and when do you want me to pay tax? Which paragraph did I indicate that? When I come down here, this is where I see tax information. All the paragraphs up there, I am not interested. I come and read. Question said profit tax of 30% per year will be payable 1 year in arrears. So I have to multiply by 30% and I shift it in arrears. So I come here. This is 30%. 30% of the 12780 will be paid in year 2. And that is going to give us 3834 minus 30% of 83055 is giving us what? 24,917. It will be paid in the following year. 30% of 76,549 will give us, is it 22,965? And then this is the time I will go and create my year 5. And 30% of 445 is what is supposed to be paid in year 5. And that is 134 minus. Then my next level is going to be on capital allowance. So what is the tax savings or tax saved on capital allowance? What is the tax saved on capital allowance? I have to go and do that workings and I will bring myself up. Okay, so let's leave space there. We go down there to go and do workings number 4, which is tax saved on capital allowances. Okay, so let's go and read what is about the capital allowances. When I come down here, I am going to see this paragraph is where I did the capital allowance indication. So that is the paragraph I would have to read. Capital allowances, tax allowable depreciation is on 25% reducing balance basis, could be claimed, okay, on the cost of the equipment. What is the cost of the equipment? This is the initial investment. That is where I indicated. I go straight. The cost of the equipment is 120,000, for which capital allowance is 25% reducing balance. I'm not sure of how you do your reducing balance, but at P4 level, I am not going to use the primary school tender some of you are using. I'm using the fastest way you can just get that 2 marks. Easy. Because the common sense is, if something is reducing by 25%, it should reduce to 75%. So when it is reducing balance, I want you to use this principle because that will save massive time. So let's go and do that shortcut, okay? Year 1, the cost of the asset is 120,000 and the reducing balance rate is 25%. And that will give us the capital allowance, okay? So your capital allowance would have been 120,000 times 0.25, and that would have given me a 30,000. If it is 30,000, my tax savings should be that 30,000 multiplied by the tax rate. And what will be the tax rate? The tax rate is giving us 30%. So I will multiply this by 30%. Okay, I will multiply that by 30%. This is the tax rate. And then that will give me the savings. Okay, 30% of that is giving me 9,000. In the exam room, do I have to do all these things there? No, I am not going to write anything like that. I'm not even going to write this 30,000 because I know 120,000 times 25% times 30% answer is simply what? 9,000. I put it there. When you come to year 2, the simple common sense is if the reducing balance rate is 25%, it means the figure that you are having should reduce by 25%. If it should reduce by 25%, it should reduce to 75%. So my tax savings in year 2 is going to be the 99,000 which I got in year 1 should reduce by 25%, and as such it should reduce to what? 75%. You come and put it there times 0.75. That will give you 1 minute. So 9,000 by 4 is just giving me 1 minute. 9,000 times 0.75 is it giving me 6750, and that 6750 should go to year 3. So 6750 multiplied by, it's also reducing by 25% again, so it should reduce to what? 75. And then you say times 0.75 again, and that is giving 5063. Okay, so the common sense is this is the fastest way, which of course, if you are in the exam room, you can even use your calculator and then you go away. Okay, now year 4, this is where you have to be with me. This is the only challenge with this shortcut principle. When there is an asset, at the end of its useful life, that asset can be sold. When we sell it at a profit, the taxman call it a balancing charge. When we sell it at a loss, the taxman call it a balancing allowance, isn't it? So therefore, at the end of the year 4, the asset will be sold, which will result into a profit or loss. What I am going to do, that profit or loss is embodied in everything. Okay? So the moment you do what I'm doing, life is going to be very, very straightforward. If you go home, you can try to do your long approach. You come and get these figures. Okay, so when you come to year 4, it's going to be, 1 minute. If you come to year 4, 1 minute please. If you come to year 4, it's going to be the difference. How do you get that difference? Be with me. Common sense is, as you learned it from your tax, the taxman will give you capital allowance based on what is called qualifying expenditure. The taxman will give you an allowance based on what is called qualifying expenditure. And what is the qualifying expenditure? The qualifying expenditure is how much did you pay for the asset, that is the cost of the asset, minus the residual value. If I bought asset at the cost of 100 and at the end of it, I sold it for 10, I haven't incurred what? 100. I have effectively incurred 90. That 90 is what we are referring to as the qualifying expenditure. Therefore, given this question, the cost of the asset is equal to 120. At the end of its useful life, they told us residual value is 10 million. So if residual value is 10 million, it means I have to deduct the 10,000 out of it. It means over the life of the asset, the taxman will allow me to deduct the qualifying expenditure of the 110,000. And if I would deduct 110,000 over the life of the asset, then what will be the total tax savings I will make? What you are saving will be the 30%, the tax rate multiplied by that. And this one is giving you 33,000. This is the total benefit you will get over the life of the asset. However, what have you done? I have claimed In year 1, 9,000. Year 2, 6750. Year 3, 5063. Therefore, what am I supposed to claim in year 4 if this is the total? That is why we say year 4 is going to be the difference. So I pick 33,000 minus 9,000 minus 6750 minus 5063, and that is giving 12187 approximate. So this is the fastest way. To be honest, I'm teaching, that's why it's taking long. If you know what you're doing, you just say cost of the asset times the reducing balance basis rate times what? The tax rate. You've got 9,000. 9,000 times 0.75 because it's reducing by 25 equals. You put a 6750. You press the equal sign, you get this. When you get to the last year, you need the difference. Come and do the cost minus residual value multiplied by the tax rate. That is the total benefit. Take the 3 years off it, and that will give you that. So now let's go up there and we go and bring the tax savings. Tax is paid 1 year in arrears. So I'm going to say 9,000, 6750, 5063, and this is 12187. 12187. Then the moment I am done with my tax savings on capital allowance, the next thing I have to think of is the capital items. What are the capital items? Initial investment, residual value, working capital, if any. So I come to the question, have you got initial investment? Question says yes, because the equipment is supposed to be bought at that 120,000 minus. Have you got residual value? Yes, because the moment I have done my capital allowances, I know those figures. So I don't go back to the question again because I've picked them for the purpose of the calculation of the capital allowance. So I'm going to say the residual value was 10 million. Then I ask the question, do you have working capital? You see the questions I'm asking. So that if I ask the question and it's not telling me I have working capital, I leave it. If I ask the question, have you got residual value? And the question says there's no residual value, you can't force yourself and you bring it. So you need to know what you're supposed to be doing at a point because it's a template. And you ask the question, I need this, where is it? You have asked me to calculate MPV. And this is what we have to do to calculate MPV. Where is this? Where is that? Where is that? You see the question giving you all the answers. So I ask the question, have you got working capital? Question says yes, because I have indicated working capital here. And when you get to working capital, you also have to ask the question again, is your working capital increasing? Because the examiner can hide something. Is your working capital increasing? This question is telling us that there is initial working capital of 20 million, but when you come down here, they said general inflation is 3% and working capital is expected to increase in the same line with what? Inflation. Therefore, the working capital will increase. So I have to go and do my workings. If you don't ask these questions, like this one for instance, you are likely to miss the increase in the working capital. Examiner can keep the working capital constant for you, or the working capital will be increasing. So me knowing the principle, I ask the question, is your working capital constant or is your working capital supposed to increase? And question will tell me, haven't you seen that I've told you working capital is supposed to increase alongside with general inflation? Okay, then I have to do my workings accordingly. That is the strategy. That's it. If you be able to do this, and that can only be done when you have learned the principle, because the question in front of you is going to be set based on that particular principle. Full stop. Okay, so without the principle, you don't answer the question. So ask questions through the principles, and the question in front of you will give you the answers. Okay, so let's go. So I need to go and do my workings on working capital and come back. So workings 5 is on working capital. Workings 5 is on working capital. How will I get the working capital? I say yes. 0, 1, 2, 3, 4. That is the number of years the project is going. Be with me. Year 0 is not a year. Year 1 is not a year. Year 3 is not a year. Year 4 is not a year. This is the meaning. Year 0 is the beginning of your 1 year life. Use your age. When the project is started now, that is the day the project is born. That is the beginning of the project year 1 life. Just as you, the day you were born, you are year 0. It will take you 12 months for you to be what? Year 1. It will take you another 12 months for you to be year 2. It will take you another 12 months for you to be 3 years, and then 12 months. So this year 1, year 0, year 2, they are not years. They are either the beginning of the year or the end of the year. So when I say beginning of year 1, beginning of year 1 is year 0. End of year 1 is year 1. Beginning of year 2 is year 1. End of year 2 is year 2. Use your age. When was the beginning of your year 1 life? The day you were born. That was when you began to go through the first 12 months. When did you celebrated your birthday that you said you are 1 year old? You celebrated it for your 1 year birthday when you have gone through the 12 months. That is the end of the 12-month period. That is when you say, I am 1. Then, when did you start through your year 2? You started your year 2 when you were 1 year. And then you became 2 years, 12 months after. So that is how the same thing you would have to use for project. Project will be born 1 day. That is the time the project starts. The 12 months after that is 1 year anniversary of the time you started. So working capital, we don't put in capital at the end of the period. We put working capital at the beginning of the period. So the working capital I need for my first year investment will be put at the beginning of year 1. And beginning of year 1 is your year 0. Beginning of year 2 is your year 1. So what then is my total working capital? My total working capital, according to the question, is saying initially our working capital will be what? 20 million. So if my working capital is 20 million, fair be it. The next question I have to ask myself is this working capital subject to growth? According to the question, working capital is supposed to increase by what? The level of inflation, which is 3%. So if it is 3%, I need to increase it by 3%. I pick my calculator, then I will say that 20,000 should increase by 1.03, and that will be, is it 2,600? And this will also increase by 1.03, 21,218, and that will also increase by 1.03, 21,855, thereabout. If this is the case, question here is, should I put some in year 4? I don't, even though some school of thought says it. If you go to the exam room, don't do it, because the practical situation is that the project is for 4 years. If I put working capital here, I'm using it for the next 12 months, because what I've put in year 0 is what I'm using for this 12 months. What I've put in year 1 is what I'm using for this 12 months. What I've put in year 2 is what I'm using for this 12 months. What I've put in year 3 is what I'm using for the next 12 months. If you put some in year 4, it means I have to use it for the next 12 months. But we said the project will end at the end of year 4. So the project is dead at the end of year 4. What do you need working capital in for? You don't need that, so don't put anything in there. Okay? So the years respect the way they flow. Okay? Now, these are the total working capitals. If these are the total working capitals, here I'm putting nothing in here. Okay? If these are the total working capitals, what will be the cash flows? So come out with your cash flows. This is what we need. The cash flows relevant should be the incremental. At the beginning, how much money did you invest? I invested what? 20,000. Come the end of year 1 or beginning of year 2, I told you my working capital is now 20,600. I increased it by only 3%, don't forget. So how much did I bring? I didn't bring 20,600. I brought only what? 600, which is the incremental. So you are looking at the difference. Then come year 2. What working capital addition? It has moved from 20,600 to 21,215. So you are going to do 21,215 minus the 20,600. And how much are you expected to get? That difference is what? 618. Then I've now brought in 21,855 compared to what was there previous of 21,215. Working capital has increased again, and it has increased by 637. Okay, and then here I put in nothing. What has happened? I was having working capital of this, and now I say it is equals to what? 0. When working capital increase, it means you have invested, money is gone out. When working capital decrease, you have recovered it, so money had come in. Therefore, I will say I have recovered my whole money. That's why they said working capital will be recouped at the end of the project, because come the end of this point, working capital is 0. So whatever I put in, I have been able to recover my money. So this is the cash flows that you need to think of. So let's go back quickly to go and bring the working capital. So I come down here. My working capital will be, I put in 20,000 in year 0. Year 1, we said it has increased to what? 600 minus. Year 2 is 618. Year 3 is 637. And year 4 is a positive of what? 21854. And this is going to be dash and dash. Okay, be with me. I'm teaching. That is why I would have to show you all that. But if you have understood the principle, there is a short way of doing all these. Working capital is expected to increase by 3%. So if I put in 20,000, I pick the 20,000 here. 20,000 times 0.03, which is the 3%. Is this 600? I put the 600 here. This 600 will increase by 3%. So I'll say times 1.03 equals. Do I get the 618? That 618 is also supposed to increase by 3%. So I multiply by 1.03. If you look on your calculator up there, you see 1.03. Answer times 1.03. So I'll press the equal sign. Do you see your 636.5, which is the 637? And then last year, I know I had to recoup it. So I'm going to add this plus that plus that plus that, and it will give me that. So what will I do? I don't even waste time to go and do the workings down there. I don't even waste time to go and do the workings down there. So let's sum them up. Let's sum them up here. And then this will give the net cash flows. So the net cash flows here will be 140,000 minus, this is 180. This is 87603. This is 57745. Forget about the approximation anyway. This is 14398. This is 1205 word 54, more or less. Okay, so 5453. Don't bother yourself with approximation there. Okay, once I've got the net cash flows, I need a discount factor. What discount factor should I use? The discount factor I have to use should be consistent with what? The cash flows. So I need to come and ask, these cash flows, who are you? And cash flows will tell me I am after inflation. So if you are after inflation, then the discount factor I will need for you should be a discount factor which is also after inflation. And that discount factor after inflation is what is called the nominal. Before I will go to the question, then when I'm coming to the question, I know I'm looking for nominal discount factor. So if I'm looking for nominal discount factor, I come question, where is your nominal discount factor? And question will tell me, this is where I've indicated cost of capital. He said real. Okay, so if you have given me real, then I don't need real. Unfortunately, I need what? Nominal. So if I need nominal, I have to convert the the real to nominal. How do I convert it? Fisher equation. I go and open. How do I convert? Fisher says 1 plus the money rate should be equals to 1 plus the real rate, 1 plus the inflation rate. I'm looking for the money rate, and the real rate is giving us 7.1 minute? Okay, it's 7.8%, so 0.78. And what inflation rate do I need there? I need the general inflation rate. And the general inflation rate is what? 3%, so 1.03. And what will be my M? M will be the 1.078 times 1.03 minus 1, and that is giving approximately 11%. And I discount this at what? 11%. Everybody at this point should be able to do the 11% discount. So let me pick you from the note, and then we pick it from there. We don't have to waste time on this discounting basic thing. Okay, so if you come to your note, we've done the solution here for you nicely. So these are the net cash flows that we got, and then 11%. I go to the discount factor table. When I go to the discount factor table, I pick the 11%. Year 0 obviously is 1, year 1, year 2, year 3, year 4, year 5. You multiply this by that and you get the present value. When you sum up all of that, then you come and get what? The MPV of the project. As the MPV of the project is positive, you will conclude that the MPV is positive, so the project is supposed to be what? Financially acceptable. So that is that. It is time pressured, as we know usually. Investment appraiser, the technique is not too difficult, but doing it is tedious and time pressured. So my advice is you have to be moving. It's not something that you're going to hesitate. What am I supposed to do next? What am I supposed to do in the note? You have to just flow. You have to just flow. Okay. Now let's calculate internal rate of return. How do we calculate internal rate of return? To calculate internal rate of return, I need two discount factors. What? And their corresponding MPVs. I need two discount factors and their corresponding MPVs. So we got the net cash flows. Our net cash flows from here is, okay, our net cash flows from the project is what we have here as that. Okay, so this is the net cash flows. So these net cash flows are what we have to get two discount factors for them and their corresponding MPVs. So I have used 11% to get one positive MPV. I know you have been told that, oh, you have to get one positive MPV and one negative MPV. That is primary school 10. If you look at the internal rate of return formula, it's telling you the internal rate of return is the lower percentage plus the MPV of the lower percentage divided by MPV of the lower minus MPV of the higher, all multiplied by the higher percentage minus the lower percentage. This sign here makes the whole difference. That minus there makes the whole difference. If you look at the internal rate of return curve, the internal rate of return curve is like this. This is the MPV and this is the internal rate of return R. And this is positive MPV, and this is negative MPV, and this is where the MPV is equals 0. So when you draw the line like this, this is the internal rate of return MPV line. It's basically seen as a straight line. So where will the curve touches what? MPV, which is equals to 0. This is the point that R will make the MPV equals to 0. This is the internal rate of return. To draw this straight line, I need only 2 points. I can have two positive here and then there. When I join, wherever they will touch the S axis or the R axis is where my internal rate of return is. I can have here and I have one positive, one negative. I join. So whichever two MPVs you will get and they are corresponding rate, it doesn't matter. This sign here is going to change the mathematics for you. Okay, because when I get one positive, one negative, negative here will convert it to plus. If I get two positive, negative will still be negative. You are just calculating a weighted average. It's just the weighted average of the two percentages. However, there is a clue you can use to get it the amount or percentage you need. So let's come back here. When we use 11%, NPV was positive. If I want a negative, what should I do? This is your interest. That is the reason why, or this is your cost of capital. That is the reason why we said don't bring interest as part of this cash flow, because that interest is what is gone here as part of the WACC. Okay, so when you bring it here and you bring it there in the cash flow, you have duplicated it. So this cost of capital, which include interest, is a cost to you. NPV is the overall profit or loss. So if my NPV is positive, as we indicated, it means the project is a profitable one. Okay, therefore, what will be the NPV negative, which is a loss? So if I've used a cost of 11 and I have made a profit, if I want to make a loss, what should I do to my cost? If you increase your cost, your profit will come down, isn't it? Therefore, if 11% has given me a positive NPV, then what percentage will bring my NPV to be negative? It should be higher than the 11%. So if you look at what they did here, they picked what? 13%. If you pick the second rate and it is still giving you positive, don't go and do that primary school thing of you doing try and error until you get one positive, one negative. It doesn't work like that. No way. Okay? Whichever two NPVs with their corresponding discount factor, put it in the formula, do the mathematics, it will bring you to that line. So when they picked the 13% and they discounted, they got NPV of what? Negative. So I have got two rates, which are 11% and 13%. And each of them had given me their corresponding what? NPVs. Can I put them in the formula? The two percentages that I got, which one is the lower percentage? Is the 11% plus the NPV of the 11%, which is the positive 956, divided by the NPV of the 11% minus the NPV of the 13%. But the NPV of the 13% is minus. Negative or minus will bring me toward the plus, and then you will bring the NPV of the 13%, all multiplied by the 13% and the 11%. When you solve it mathematically, that should give you 11.31%. Should we accept the project? We said that internal rate of return conclusion is that if that internal rate of return is greater than the cost of capital, NPV will be positive and the project should be what? Acceptable. So if I have got this single project, as long as the NPV was positive, telling me that the project is financially acceptable, internal rate of return will obviously be more than what? The cost of capital, and internal rate of return will also say yes, the project is financially what? Acceptable. The project is financially acceptable. Okay, now let's move on to the next. One minute, let me check if a question had come up. Okay, brilliant. The next thing that we need to do is the discounted payback period. How do we calculate the discounted payback period? We said is the number of years the present value of the cash flows will be recovering the initial investment. So where is the present value? Come back to your NPV that you calculated. This is where you get that information. I need the number of years the present value of the cash flows will recover the investment. These are the present values of the cash flows. So that is what you would have to come and copy. Okay, so that is what we have copied down here. The net cash flows discounted to that, and we got the present value. In the exam room, why should I do all this? No way. Because I have already got the present value. I don't have to repeat it. Unless they haven't told me to calculate the NPV, and I will need to do this. But if I've been asked to calculate the NPV, it means I've already got the present values. How many years the present values of the cash flows will be able to recover the investment? You have to do the cumulative First one is year 0, I have put in 140. Year 1, I got 10,974. So if I've got 10,974, I have to take it from the 140. It will remain what? 129 to recover. Then I also made 71 in year is it 2? Take it from that and it will remain what? 57. Year 3, I made 42. Take the 42 from that, it will be left with what? 15680. You are doing it until that 140 become what? 0. Year 4, I made 9488. Take it from that. It means at the end of year 4, I am left with 6192 to recover. If I'm left with 6192 to recover, year 5, I made what? 7148. If I've made 7148, then what should I do? It didn't take me the whole of that year. It took me some period because I told you, if this is year 4, this is year 5, this is not the year, this is not the year. This period is the 12-month period. So between year 4 and year 5, 12 months, I made 71, but I need to recover what? 6192. So it will be covered within. It won't go up to the end of year 5. Okay? So you have to do the proportion. And the common sense is, if the whole of that year 5, 1 year, I made cash flow of 7148, when within the year, I was able to make the 1692, you do the cross multiplication. My X should be equal to 6192 divided by 7148. And that is giving 0.87. So common sense here is that it took me 4 and then 0.87 years to recover the money. Okay, and that is the discounted payback. This is still a primary school 10. Okay, so that is basically the case. And then what next are you supposed to think of? When we calculate the discounted payback and we get a 4.87, should we accept the project or not? Answer is that we wouldn't be in position to do that. Why can't we be in position to come out with a conclusion? Because this question didn't give us a target word, discounted payback. So I'll tell the examiner in this case, I am not in position to use the discounted payback to form the conclusion because a discounted payback target is not given. So I haven't got any benchmark, and as such, I can't form that conclusion. So this is basically NPV. This is basically NPV and the primary school techniques. The other ones are coming. We are leading you one to the other. Now let's move on to the next heading, which is when to claim capital allowances. Okay, when to claim capital allowances. From F9 up to what we've done tonight. Every time when we are calculating tax savings on capital allowance, we start from year 1. From this time onwards, don't just go straight and say, I am going to start from year 1. It doesn't work like that. Because the common sense here is that tax is not based on cash profit. Tax is not based on capital allowance. Tax is a percentage based on taxable profit. Okay, so what we are trying to do here is that we want to know when the capital allowance will go to the income statement for the calculation of taxable profit. The time the capital allowance will go to the income statement, that is the time the capital allowance will save you tax. So there are two ways the examiner is going to test you according to your syllabus. Either the capital allowance will start to be claimed from year 1, as we know already, or capital allowance will be claimed from year 0. This is the new one we have to pay particular attention to, because the one that we are claiming from year 1, we know it. So either capital allowance will be claimed in year 0, or capital allowance will be claimed from year 1. So for instance, if I have got a project and I am claiming the capital allowance from year 0, and the project is for 4 years, I will claim year 0, year 1, year 2, year 3, full stop. This is when I'm claiming from year 0. If I'm claiming from year 1 and the project is for 4 years, I will claim year 1, year 2, year 3, year 4, isn't it? So this is how the examiner is going to put it in the question. We'll tell you capital allowance is claimed in advance. If capital allowance is claimed in advance, then you are starting to claim from year 0. If capital allowance is claimed in arrears, then you are starting to claim from year 1, as we normally do. Okay, so that is the case. This advance and arrears in the capital allowance is different from tax being paid in advance or being paid in arrears or relevant years. So handle capital allowance when you get a capital allowance before you go and see how is tax paid. So as usual, if I say the capital allowance is claimed in arrears, I will start to claim from year 1. And when I get the capital allowance and I get the tax savings, I will ask the question, when is tax supposed to be paid? If the question also in addition tell me tax is paid in the relevant years, it means the tax savings on the capital allowance will also be year 1, year 2, year 3. But if the tax is paid in arrears too, then the tax savings on capital allowance will be claimed what? Year 2, year 3, year 4. So this is the capital allowance and this is the tax. If I'm claiming tax in relevant years, this is what will happen. If the tax is also paid in arrears, this is what will happen. So separate the two. If the question tell me capital allowance is claimed in advance, I'm starting to claim from year 0. So this is the capital allowance. What will be the tax? Tax is paid in relevant years. I will pay year 0 like this. If tax is paid in relevant years, that is what will be. If the tax is paid in arrears, then I will pay year 1, year 2, year 3, and then I will come and pay what? Year 4. So watch out. They are not the same. So either the examiner is going to say, oh, capital allowance is in advance, capital allowance in arrears. So the capital allowance, get the tax savings. When you are going to get the tax savings in the cash flows, ask the question, when do you want me to pay the tax? They are two different things. Alternatively, the examiner might not use capital allowance is in advance or in arrears. The examiner will be using accounting date. And this is where you have to be with me. So I'm going to use the question in our lecture note to explain when the examiner uses accounting date. The thing you are looking for is, when will the capital allowance go to the income statement for the purpose of what? Preparing the account. If account will be prepared 12 months from the beginning of our project, then capital allowance will be going in advance, arrears. This is what I'm using the question there to illustrate. So let's go to our note. If you come here, examiner has got two things to test you on. He can say accounting date. If we start the project, be with me when he is using accounting date. If we start the project at the beginning of an accounting year, let me illustrate. If we start the project at the beginning of accounting year, let's assume, for instance, we prepare account 31st December every year. If I prepare account 31st December every year, and I start a project on 1st January of that year, this is the project year 0. Project year 1 will be 31st 12, the following, that year. So between the time I start the project up to this point, this is my year 1. Because I prepare account 31st December every year, I am not preparing the account on 1st January. That account will be prepared at 31st December. And that is the time capital allowance will be deducted for the calculation of the taxable profit. In that case, capital allowance will go to the income statement 1 year from the time I started the project. And that is when capital allowance will be starting to be claiming from year 1, as we've been doing. Alternatively, The examiner will also say, oh, we prepare account 31st 12 every year, but we are starting a project on 31st 12 of this year. If I'm starting project on 31st 12 of this year, this 31st 12 project life is 0. When will account be prepared? Account will be prepared on that same day. So if account will be prepared on that same day, that is the time capital allowance should hit that income statement we prepare an account. Remember, the taxman doesn't know accrual concept. So the taxman was, oh, you are preparing the account, so you have to claim your capital allowance in advance. So when I'm doing the project at the beginning, that's what we've done here for you. When the project is being done at the beginning of an accounting year, it means you are claiming capital allowance from year 1. But when the project is undertaken at the end of the accounting year, that end of the accounting year, an account is being prepared, and that is year 0 of the project life. So capital allowance should start from year 0. When you start solving some of the P4 questions, you will see that sometimes capital allowance, they start from year 0, and you are going to start from year 1. And you ask yourself how. Okay? The how, the answer is this. When are you starting the project? Even though I have to emphasize some of the questions, the examiner don't state whether in advance or in arrears. And you see some of the solutions, they are claiming it from year 0. That is the assumption that they made. So if the question don't state anything that you are claiming it in advance or in arrears, my advice will be that claim it from year 1, because that is what you are more comfortable of doing. Okay, so let's take this question to illustrate. AAPLC buys a fixed asset for 10,000 at the beginning of an accounting period to undertake a 2-year project. Net trading revenue at T1 and T2 are 5,000 per annum. The company sells the fixed asset on the last day of the second year for 6,000. Corporation tax 33%, written down allowance 25%, reducing balance. Calculate the net cash flows for the project. Okay, I'm not worried about the cash flows orders. I'm only looking for the capital allowance. Okay, question is telling me project is 2 years. So year 0, year 1, year 2. I will keep space for year 3 as we do. Net trading word, result or revenue is your revenue minus your variable cost minus your fixed cost, which is the same as your cash profit. It's 5,000 every year. We bring the 5,000. If you get your cash profit, you have to bring your tax. Tax rate is what? 33%. 33% of the 5,000 is here. The question didn't say it is in arrears or whatever, but here they assume it is in arrears. If they don't, you assume that it is in relevant years to make life easy. I'm not so much keen about that because everybody is okay with cash profit, your tax, your initial investment, your residual value. What I'm interested in is the capital allowance at this moment. When should I claim capital allowance? Okay, when should I claim? Should I claim it in advance or should I claim it in arrears? So from now onwards, when you are going to calculate the capital allowance, this question should come up. Go back and ask the question in front of you. Do you want me to claim the capital allowance from year 0 or do you want me to claim the capital allowance from year 1? Okay, and here we are starting this project at the beginning of an accounting period. So when will account be prepared? Account will be prepared 12 months after, because we don't prepare account at the beginning. We prepare account at the end. So capital allowance will go to income statement at the point of preparing the account, which is 12 months from now. And 12 months from now is 1 year. So my first capital allowance will charge to the income statement 12 months from now. So capital allowance is claimed in year 1, which is going to follow our normal approach. Okay, it's reducing balance. I don't want you to go and do this primary school thing. I want us to be okay with a 75% rule. So this, I would have done it straightforward. I would say year 1, I'm claiming from year 1. I will say the cost of the asset is 10,000 and it's of reducing balance of 25%, and the tax rate is 33%. How much will I get? So 10,000 times 0.25 times 0.33, that gives me 825. Because the project is for only 2 years, this one should be the difference. And the difference is that I bought the asset at the cost of 10,000. I sold it for what? 6,000. It means I incurred a qualifying expenditure of 4,000. Tax rate is 33%. 33% of that 4,000 will give me what? Is it 1320? And I have already claimed, this is the total I have to get over the life of the asset. I have already claimed this. So how much is it left to be claimed here? That is the difference. So 1320 minus 825, and that is the 495 they got for you. Okay, so this is the normal one that we know. Okay, so when we come here, that is how they got what? The 825 and then what? 495. Because we are assuming here that tax is paid 1 year in arrears. Now let's take another example to illustrate where we are claiming in advance. BB PLC buys a fixed asset for 10,000 at the end of the previous accounting period, 31st December 2000, to undertake a 2-year project. The moment we are doing the project at the end of an accounting period, that same day the project is year 0, account is being prepared, and capital allowance should be calculated and charged against that income. Therefore, you have to claim it in year 0. Okay, net trading result is 5,000, and then the fixed asset has zero scrap value when it is disposed of at the end of the 2nd year. Corporation tax is 33%. Written down value is what? 25%, reducing balance. When you are claiming it from year 0, it is slightly difficult. So be with me here. Okay. Once again, I'm not interested with the 5,000 and the tax on the cash profit. I'm also okay for you and the initial investment. The question told us residual value is absolutely what? 0. So that is gone. Now let's see the tax savings on capital allowance. This is where my concern is. So BB, we're going to follow the same principle. When am I supposed to start to claim the capital allowance? I am supposed to start claiming the capital allowance from year 0 because I'm doing the project on the same day an account is supposed to be prepared. Okay, so that is year 0. So if it is year 0, I will say the cost of the asset is 10,000 multiplied by the reducing balance of 25% multiplied by the tax rate of 33%, and that is giving me, so 1,2,3 times 0.25 times 0.33 is it 825. Is it 825? Next, year 1, now be with me. The asset is for 2 years. What we did here is for 2 years. This includes your tax savings on capital allowance and the balancing charge or balancing what? Allowance. Okay. The balancing charge and balancing allowance will only occur when the asset is sold. Okay. And when we are claiming capital allowance in advance, it's only capital allowance that you can shift it up. So the capital allowance I ought to have claimed in year 1 is what I'm claiming in year 0. Capital allowance I have to claim in year 2 is what I will claim in year 1. But balancing allowance or balancing charge, which is the profit or loss on the sale of the asset, cannot be moved forward. That can only happen when the asset is sold. And the asset will not be sold in year 1. The asset will be sold at the end of its useful life. So we cannot say, come and do the balance here. No. The only thing you are moving 1 year ahead is only the capital allowance. So here, when I come, I'll come and say that 825 capital allowance reducing balance rate is 25%. So this one will be 75%. If it's reducing by 25%, it should reduce to what? 75. So 825 times 0.75 is this 61 what? 9. Okay. Then when I come here, I will come and look at the difference. So watch out. This is what makes the whole thing. So I bought the asset at 10,000. Residual value is 0. This is 10,000. I multiply by 33%. And this is 3,300. This should be the difference. So I've claimed 825. I've also claimed 619 out of the 3,300. And that is giving 1856. And that is giving 1856. So that is the calculations you need to watch out. Okay, so here, when you are about to start calculating capital allowance, you would have to make sure that you know your when date you are supposed to claim it. Our time is up. Okay, as I told you, this chapter is big, so we couldn't finish it. I'm going to pick it from there, from modified internal rate of return next week. Okay, but we'll definitely bring ourselves to that level as we go on, because other chapters are not as demanding as this. Okay, so we are going to end here. And in the meantime, any questions that you have, make sure that you pass them to me. Make sure that you pass them to me. Okay, I wouldn't hesitate to push you to the revision kit now for questions, because P4 questions are interrelated. You need so many topics before you be able to solve one big question. So I don't want to discourage you first. So what I want you to do is, what we've done tonight, sit down, look at it, make sure you've got the principles right, so that when we have to apply it from a given question or a bigger question, you will be in position to be able to do that. So I would have to say thank you very much for your time, and I will see you next week.